Okay, let's unpack this. Picture yourself running a lemonade stand. Pretty simple, right?
Yeah, basic business.
You buy your lemons, your sugar, your cups. Those are your costs. You sell the lemonade for more than those costs, and what's left over?
That's your profit? Easy enough?
Easy enough for one stand. Now, take that same idea, but think about it. For every single business in the entire country, all added together, not just your lemonade stand, not just Apple or Ford, but the total aggregate pool of profits for all corporations, where does that come from?
Right, it's a much bigger question.
You-
And you might think, well, it's just adding up all those individual profits, right? Every business selling stuff for more than it costs them.
That seems like the obvious answer.
It does.
Yeah.
But when you zoom out, when you look at the whole economy, the macro level, the answer turns out to be, well, incredibly surprising. It's almost kind of backwards compared to what feels like common sense.
Welcome back to the deep dive.
Today, we are really diving into one of the most fundamental and maybe one of the least understood questions in economics. The true origin of aggregate corporate profits, the total profit pie for the whole economy.
And why should you, listening right now, care about where this total sum of profits comes from?
Because this isn't just some, dry accounting thing for folks in suits. Understanding this gives you a really powerful lens. It helps you make sense of major economic news you hear every day.
Things like what?
Things like job numbers, inflation rates, those big debates about government spending and national debt, even how trading goods with other countries affects us here at home. It sort of reveals a hidden engine driving the economy.
And that's really our mission in this deep dive today. We've gone through some, frankly, quite dense economic research on this exact
Yeah,
topic.
some heavy lifting, yeah.
Definitely. And we've pulled out the most important concepts, the key nuggets of knowledge for you. We're going to try and guide you through how economists actually figure this stuff out.
We'll show you a fundamental rule. It's almost like an accounting law for the entire economy that breaks down the sources of these total profits.
And we won't just show you the equation. We'll actually trace the flow of money, like watching water move through pipes, to see how these different sources physically generate that big pool of profit.
Get ready for hopefully, some aha moments, some things that might just flip your assumptions upside down.
We'll also explore different ideas from various economic schools of thought about why profits even exist. Is it just a reward for hard work and taking risks? Or are there other, maybe less obvious forces at play?
And we'll uncover how seemingly separate parts of the economy, things like your own personal decision about whether to save or spend your paycheck, how much the government spends versus how much it taxes, how much we import versus export, and yes, even tax policies, how all these things play a direct and often really surprising role in determining the total size of that profit pie available for every company out there, from the tiniest startup to the biggest multinational corporation.
It's definitely a perspective that challenges a lot of conventional thinking. So let's jump right in. First things first. Why is it so critical to look at the total profits for the whole economy, the aggregate picture, instead of just focusing on one company's success or failure?
Well, think back to that lemonade stand again. For that single business, profit is absolutely everything, right? It's the signal.
Tells them if they're winning or losing.
Exactly. It tells them if they should maybe hire another helper, buy a second table, maybe even open another stand down the street. Or if profits are bad, maybe it's time to rethink the recipe or even pack it in. The research we looked at calls profit the essential motivation for pretty much all activity in a capitalist system. An individual company's profit level strongly influences its decisions about producing more or less, hiring or firing, investing in the future, or pulling back.
Okay, that makes sense for one company, but how does that scale up?
Well, just like individual profit drives individual company decisions, the aggregate profit, the total sum for all companies, has these huge ripple effects across the entire economy. When aggregate profits are generally healthy and rising, businesses across the board tend to feel more confident.
So they invest more, hire more people.
Generally, yes. They're more likely to expand, invest in new equipment, hire more staff, increase production. Conversely, when aggregate profits are low or falling across the economy, you see businesses pull back, become more cautious. So this overall aggregate profitability level strongly influences the big economic trends we see, like total national production, overall employment levels, and the total amount of capital spending happening nationwide.
It's like the tide that lifts or lowers all the boats.
That's a good way to put it. And the researchers we reviewed point out something really interesting here. They note that conventional macroeconomics, the study of the economy as a whole, often talks a lot about things like GDP, gross domestic product.
Right, the total value of everything produced.
Exactly. But, they argue, it rarely considers the role of total profits.
That seems like a massive blind spot. It's like trying to judge how healthy a huge corporation is by only looking at its total sales revenue, but completely ignoring its actual profit, its bottom line. Is it actually making money on all those sales?
Precisely. The analysis we reviewed argues really strongly that any comprehensive analysis of business cycle dynamics, meaning understanding why the economy goes through those booms and recessions, must consider aggregate profits. You can't get the full picture without looking at the bottom line of the entire business sector. They actually call focusing on how this total profit gets created the profits perspective.
Look, a profits perspective.
And they say this perspective gives you a different, maybe broader view of the economy. It's described as a financial view. It helps you see the underlying forces that drive prosperity, but also the things that could threaten stability, both within the country and, globally. It helps make sense of really complex issues like government deficit spending, the ups and downs of business cycles, and those persistent trade imbalances you hear about. It's about following the actual money flows.
So this core question, where do aggregate profits actually come from, forces us to think at the macro level, the whole economy, not just the micro level of one business trying to cut costs or boost sales.
Yes. And this brings us directly to a really important warning sign, the research flags. The fallacy of composition.
The fallacy of composition. This is a classic logic trap, right? Assuming what's true for one part must automatically be true for the whole thing.
Exactly. The source material gives a great simple analogy. Think about one spectator at a crowded football game. If that one person stands up, they probably get a better view.
Makes sense.
But what happens if everyone in the stadium stands up?
Then nobody sees any better than they did before. Everyone standing just cancels each other out.
Right. And this fallacy applies directly and crucially to understanding aggregate profits. Think about it at the micro level for a single company. What's a standard way for a manager to try and boost that company's profits?
Cut costs, usually. Layoffs, maybe reduce wages or benefits if they can.
Classic cost cutting. If they pay less in wages, but their sales revenue stays the same, their individual profit goes up. Simple math for that one firm. So the common belief, the sort of intuitive leap, is that if all companies across the economy did this, if everyone cut payroll costs, then total profits for the entire economy would also have to go up.
But the fallacy of composition suggests that's wrong. Why?
Because for the entire business sector combined, cutting wages isn't just a reduction in expenses, it's also simultaneously a reduction in revenue. Where do businesses ultimately get their revenue from?
From people spending money, customers.
Right. And where do most customers, households, get the money they spend?
From their jobs. Wages and salaries.
Exactly. So if all businesses cut wages significantly, that means households, in aggregate, have less income. Less income generally means less spending on the goods and services that businesses are selling. So while cutting wages reduces business expenses, it also reduces the overall flow of revenue coming back into the business sector. The source is very clear on this. At the aggregate level, cutting payrolls will not directly increase corporate profits. The reduction in revenue offsets the reduction in cost in that direct flow.
Okay, that's a huge point. What works for one company acting alone doesn't work if everyone does it, because the actions change the overall conditions.
Precisely. It might have indirect effects later, maybe on competitiveness or something, but the direct impact isn't positive for aggregate profits. Think about the treasure hunt analogy mentioned in the research. An individual company might boost its own profits by being smarter or faster than its rivals, basically finding more prizes in the treasure hunt than the others. That's a micro-level gain. But our deep dive today isn't about how one company finds more prizes. It's about what determines the total number of prizes available in the first place for all the companies to fight over. That number is set by these bigger macroeconomic forces.
Got it. So how do we figure out what determines that total pile of prizes, the aggregate profit pool? The research uses two main methods, right?
Yes, two approaches. First, there's what they call the identity method. This is basically like setting up an equation based on definitions and accounting rules for the whole economy. Gives you a quick answer.
And the second method?
The second is the flows method. This is more intuitive, maybe. It involves tracing the actual movement of money through the economy, like following the pipes, to see how profits physically accumulate in the business sector.
Let's start with the first one, the identity approach. How does that work?
Okay, method one, the identity approach. This starts with some basic accounting concepts, but applied to the entire economy, not just one firm. Think about the profits that businesses have after they pay their corporate taxes and after they've paid out dividends to their shareholders. What's left?
That's the money the business sector keeps, right? What they've managed to save or accumulate.
Exactly. In national accounting terms, this is called business saving. It represents the increase in wealth accumulated by the business sector as a whole during that period.
Okay, so profits after tax and dividends equal business saving. But businesses aren't the only ones saving money in the economy, right?
Not at all. Households save money, that's personal saving. The government sector can also save if it runs a budget surplus, takes in more taxes than it spends, or it can dissave if it runs a deficit, spends more than it takes in.
And what about other countries?
Right, the foreign sector. If our country buys more goods and services from the rest of the world than they buy from us, the trade deficit, then the rest of the world is accumulating financial claims on us. From their perspective, they are saving relative to our economy. So we have household saving, government saving, which can be negative, and foreign saving, linked to the trade balance.
So you have business saving and all this non-business saving. How does that help us find profits?
Here's where a fundamental principle of national accounting comes in. It's a core identity, like a balancing rule for the whole economy. It states that over any period, the total amount of new wealth created in the economy must equal the total amount of new wealth accumulated or saved by everyone in that economy.
New wealth created equals new wealth saved.
Yes, the creation of new wealth is generally called investment. And importantly, in this context, investment means creating new real assets. Things like constructing new buildings, manufacturing new machinery, adding to inventories of goods, building houses. It's about tangible additions to the economy's productive capacity or stock of assets.
So it's not about buying stocks or bonds.
Generally, no, not in this definition of national income accounting investment. Buying stocks or bonds is mostly just transferring ownership of existing assets or financial claims. It doesn't in itself create new wealth for the economy as a whole at that moment, though it facilitates the process. Investment here is about the physical creation.
Okay, so investment, new wealth created is total saving, new wealth accumulated.
Exactly. And we know that total saving is just the sum of saving by all the different sectors in the economy. So total saving, business saving plus non-business saving, where non-business saving is the sum of household saving, government saving, and foreign saving.
So we can substitute that into the first equation.
We can. If investment total saving, then investment business saving plus non-business saving.
Ah, okay. And if we want to isolate business saving, we just rearrange that equation.
Simple algebra. Just subtract. Non-business saving from both sides. You
Yeah.
get business saving, investment non-business saving.
Business saving equals investment minus non-business saving. What does that tell us?
It tells us that the wealth accumulated by the business sector, their saving, is equal to the total new wealth created in the economy, investment, minus the portion of that new wealth that was accumulated by everyone else, the non-business sectors. Businesses get what's left over after households, government, and foreigners take their share of the newly created wealth through their own saving.
Okay, that makes sense. Now, how do we get back to profits from business saving?
Remember, we define business saving as profits after taxes and dividends have been paid out. So we can just replace business saving in our equation with that definition. Profits after taxes and dividends, investment non-business saving.
Got it. So the profit kept by businesses equals total investment minus what others saved. But usually when people talk about corporate profits, they mean profits before taxes and dividends are taken out. How do we get to that number?
We just add those items back in. If the equation shows profits after those distributions to find the profit before them, we simply add taxes and dividends to both sides. That gives us the full identity. Profits before tax plus investment non-business saving plus dividends plus corporate profits taxes.
Okay, let's pause there. Profits, investment non-business saving, plus dividends, plus corporate taxes. This is the profits equation derived using the identity method.
That's it. It identifies the components that, by definition, add up to or subtract from aggregate pre-tax profits. The source emphasizes this as an identity. It's like saying 2 plus 2 equals convertible statement based purely on how we define the terms in national accounting.
But, and this seems like a really important but.
Yes, a very important but. The source warns us again. This identity, derived purely from accounting definitions and algebra, says nothing about causality. Meaning, just because the equation shows that profits are equal to investment minus saving plus taxes and dividends, it doesn't by itself prove that changes in investment or changes in saving decisions by others, or tax policies or dividend payouts cause profits to be what they are. It just tells us they are always equal, like an accounting balance sheet always balances.
Right. It's like that analogy you used earlier. Knowing that the number of cars equals the number of wheels divided by 4 doesn't tell you that dividing wheels by 4 causes cars to appear. It's just a definitional truth.
Exactly. To understand the causal relationships, what actually drives profits, we need the second method. We need to trace the money flows.
Okay, let's move on to method 2, the flows method. This sounds more like watching the plumbing of the economy.
That's a great analogy. The idea is to visualize money flowing through the economy like water through a network of pipes. Wages, profits, revenues, taxes, these are all flows of money. We want to focus specifically on the flows of money into and out of the aggregate business sector.
So money flowing in would be revenue for businesses.
Right. And money flowing out of the business sector would be expenses, like wages paid to households, or taxes paid to government, or payments for imported goods. The difference between the total inflow, revenue, and the total outflow, expenses, over a period is the aggregate profit.
How does the research model this?
They use a simplified visual model. Imagine all the money flowing into the entire business sector arrives through one big revenue pipe. All the money flowing out as expenses leaves through an expense pipe. There's a profit meter connected between them that measures the difference. If the inflow through the revenue pipe is greater than the outflow through the expense pipe, the meter shows a positive profit, and that profit amount flows into a big net worth tank, representing the accumulated wealth of the business sector.
And if expenses are greater than revenue?
Then the profit meter shows a loss, and wealth effectively flows out of the net worth tank. If revenue exactly equals expenses, the profit meter reads 0, and the net worth doesn't change from operations.
Now, you mentioned earlier that for the aggregate business sector, transactions between businesses mostly cancel out. Can you explain that again?
Sure. Think about Ford buying steel from U.S. Steel. For Ford, paying for the steel is an expense. For U.S. Steel, receiving that payment is revenue. Since both Ford and U.S. Steel are part of the aggregate U.S. business sector, that money just moved from one company's account to another within the sector. The total revenue for the sector didn't change. U.S. Steel's revenue went up, but it was offset by Ford having less cash, which isn't an immediate expense. And the total expense didn't change immediately in the aggregate profit calculation. Ford's payment isn't an expense for profit calculation yet. It goes into inventory cost. So these internal transactions don't directly generate aggregate profit.
So the profit meter is really measuring the net flow between the business sector and other sectors, households, government, the rest of the world?
Primarily, yes. Although, as we'll see, business investment spending, even when it's buying from another domestic business, does impact the aggregate profit flow in a special way.
Okay, let's build this up step by step, like the research does. Start super simple. Step A, just households and businesses. Businesses only produce consumer goods, and crucially, there's no saving or investment yet.
Right. The simplest possible circular flow. Businesses need workers, so they pay wages to households. Let's use the source's example number. Say businesses pay out a total of $1,000 in wages. This $1,000 flows out of the business sector through the expense pipe.
Households receive this $1,000 as income, and in this very basic model, what do they do with it?
They spend all of it.
Yeah.
Every single dollar they received in wages is spent buying consumer goods and services from the business sector. So $1,000 flows back into the business sector through the revenue pipe.
Okay, so $1,000 flowed out as expenses, wages, and the $1,000 flowed back in as revenue spending. What's the profit?
Revenue, $1,000 minus expenses. $1,000 equals 0. Aggregate profit is 0. And the source makes a really striking point here. If the household sector spends all of its income, business could never make a profit, even if consumers spent every cent they earned. The money just goes around and around, but no surplus accumulates for the business sector as a whole.
Wow. Okay, that alone is pretty mind-bending. Just circulating money doesn't create profit for the system. So how does profit actually emerge? Let's go to step B, add personal saving.
This is where it gets really interesting and maybe counterintuitive. In reality, households don't usually spend every single penny they earn. They save some portion of their income.
Okay, so let's stick with the example. Households still receive $1,000 in wages from businesses. But now, let's say they decide to spend only $940 and save the remaining $60.
What happens to that $60 they saved? It doesn't flow back to the business sector as spending. The source says this saving diverts some money from cycling back to the business sector as expenditures. It's like some of the water flowing out of the household sector doesn't make it back to the business sector's revenue pipe.
So the business sector still paid out $1,000 in wages, that's the expense outflow, but now only $940 is flowing back in as revenue from household spending.
Exactly. So now calculate the profit. Revenue, $940 minus expenses, $1,000.
That's negative $60, a loss.
Yes. In this simple model, with only wages and consumption and saving, the aggregate business sector experiences a loss, exactly equal to the amount that households saved. The equation at this step is simple. Profits, negative $60. Personal saving, $60.
Hold on, you're telling me that when households decide to save money, which we're always told is a good, responsible thing to do, it actually causes the total pool of profits for all businesses combined to go down. That feels completely backwards.
It absolutely feels backwards from our personal experience, doesn't it? Saving is prudent for an individual or a household building wealth. But remember the fallacy of composition. What's true for one household doesn't automatically scale up to the whole economy in the same way. At this aggregate level, the act of saving by households causes that amount of money to be withdrawn from the circular flow of income back to businesses. It directly shrinks the potential revenue inflow for the business sector, while their initial expense, the wages paid out, remains the same. So yes, in this flow model, personal saving appears as a direct negative source of aggregate profits.
Okay, that's a massive aha moment, even if it's uncomfortable. Personal savings subtracts from the profit pool in this direct flow analysis. My brain is slightly hurting, but let's keep going. What happens next? Step C. Add net investment.
Right. So far, our model is too simple because it doesn't include the creation of new capital goods, the investment piece. Net investment is about businesses creating new tangible wealth, building new factories, buying new machines, adding to their inventories. This is where spending by businesses can actually become revenue for other businesses in a way that boosts aggregate profit.
How does that work? If Ford buys a new robot from QK Robotics, isn't that just an expense for Ford and revenue for QK? Doesn't that still cancel out within the business sector?
Not quite, because of how investment is treated in national income accounting and business accounting. When Ford buys that new robot, let's say it costs $300, using the sources number for gross fixed investment. For Ford, the buying company, this is an exchange of cash for a capital asset. Crucially, for calculating Ford's current profit, that $300 payment is not counted as an expense at that moment.
Why not? They spent the money.
Because it's considered capital expenditure. They acquired an asset that will generate value over many years. That cost will be recognized gradually over the robot's useful life through depreciation charges. But at the time of purchase, the source says, no money flows through the profit meter and out the expense pipe for Ford. It's an asset swap, not an immediate operating expense hitting the profit calculation.
Ah, I see. Money leaves Ford's bank account, but it doesn't reduce their reported profit right now. Okay. What about QK, the company that sold the robot?
For 2K, the $300 they receive is revenue from a sale. And since both Ford and QK are part of the aggregate business sector, that $300 has flowed into the business sector's revenue pipe to get QK from an internal transaction, the purchase by Ford. But there wasn't a corresponding immediate $300 expense flowing out of the expense pipe for the sector as a whole.
So the active gross fixed investment creates revenue for the aggregate business sector without generating an immediate offsetting expense in the profit calculation. That means it must add to profits.
Exactly. Gross fixed investment is a positive source of aggregate profits. So let's update our equation. We had profits, personal saving, $60. Now we add gross fixed investment. Profits, $240 plus gross fixed investment, $300. Personal saving, $60.
Okay, investment adds to profits, saving subtracts. Now, you mentioned depreciation earlier. How does that fit in? That's called capital consumption allowances in the research, right?
Yes. This accounts for the fact that fixed assets like Ford's new robot or buildings or computers wear out or become obsolete over time. They lose value. This loss of value is treated as an expense for businesses.
But when a machine just gets a year older, no actual money changes hands, right? It's just an accounting entry.
Precisely. It's a non-cash expense. It reduces the measured value of the business sector's assets, and accountants charge it against profits. But no money actually flows out of the business sector to another sector because of depreciation. The source uses the nice image of accountants charging depreciation as if money did flow out the expense pipe and down the depreciation drain.
So it's an expense hitting the profit calculation, but without any corresponding revenue flowing in. That sounds like it must reduce profits.
It does. It represents a real loss of economic value, the wearing out of capital.
Hmm.
So capital consumption allowances are a negative source. They diminish the net gain in wealth from investment. Let's add it to the equation. Profits, $80 plus gross fixed investment, $300. Capital consumption allowances, $160. Personal saving, $60.
Okay, so gross fixed investment adds, but the depreciation, capital consumption subtracts. The difference between those two, $360, is net fixed investment.
Correct. Now there's one more part to investment, inventory investment. This is when businesses increase their stocks of unsold goods, work in progress, or raw materials.
How does building up inventory affect profits?
Similar to buying a fixed asset like a machine. When a company produces goods and puts them into inventory instead of selling them immediately, the costs of producing those goods, wages, materials, have been incurred. However, in standard accounting, those costs are attached to the inventory asset. They don't count as an expense against revenue, cost of goods sold, until the inventory is actually sold. If the inventory is built up using inputs bought from other businesses, the money paid cycles back as revenue within the sector.
So increasing inventory is like investing. It boosts revenue within the sector without an immediate offsetting expense charge.
Essentially, yes. The money paid for the goods going into inventory, if bought from other businesses, or the resources used to produce them, represents activity that generates income, but the cost isn't recognized against profits yet. The source shows this increase in inventory, $10 in the example, adding to profits. So inventory investment is also a positive source.
Let's add that in. Profits, $90, plus gross fixed investment, $300, capital consumption allowances, $160, plus inventory investment, $10. Personal saving, $60.
Yeah.
And I assume if inventory decreases, like selling off old stock, it would be the opposite.
Yes, a decrease in inventory, selling more than you produce in the period, or writing off obsolete inventory, means you're recognizing costs from previous periods or losses now, which acts as a drag on current profits. It's like a loss of wealth, a negative source.
Okay. So if we combine net fixed investment, gross fixed investment minus capital consumption, and inventory investment, we get total net investment for the economy.
That's right. Net investment, net fixed investment plus inventory investment. In our example, net investment plus $10 plus $160, plus $10 on $150. So we can simplify the profit equation at this stage too. Profits, $90 plus net investment, $150. Personal saving, $60.
This flows method is really starting to show the causality. Investment decisions by businesses initiate these flows that cause profits to increase, while personal saving decisions by households initiate flows that cause profits to decrease by diverting money away from the business revenue stream.
Exactly. And the source makes the point again here. While individual businesses make investment decisions, they generally can't just decide to invest more today to guarantee their own profits increase today. They're too small relative to the whole economy. Their individual slice of the profit pie depends on the size of the total pie created by these aggregate macro flows of investment and saving. Personal saving, on the other hand, is largely at the discretion of consumers, and profits change in direct, immediate response to those household decisions to spend or save.
Okay, we've got households and business investment. Let's add more players. Step D, the foreign sector. We buy imports, we sell exports. How does international trade fit in?
We need to look at the net flow of money between our domestic economy and the rest of the world. When people or businesses in our country make payments to foreigners, for example, buying imported cars, paying licensing fees to foreign companies, or paying interest on money borrowed from abroad, that money flows out of our domestic circular flow.
It leaves the country.
Right. The source explains this money is either paid directly out of business revenues, or it's household income that gets spent on imports instead of domestic goods. Either way, it's money lost to the domestic economy that could otherwise have become revenue for domestic businesses. Let's say these total payments are $150, $135 from business, $15 from households in the example.
And money flows in too, right? When we sell exports or when Americans receive investment income from assets held abroad.
Correct. Receipts from foreigners, payment for our exports, tourism spending here, income from foreign investments, that money flows into our domestic economy. It adds to domestic business revenue or household income. Let's say these total receipts are $120, $110 to business, $10 to households.
So in this example, we paid out $150 and received $120. We sent more money out than we got back.
Yes. The net outflow is $30. When total payments to the rest of the world exceed total receipts from them, this is known as a current account deficit. It means that, on balance, the rest of the world is accumulating financial claims on our economy, or accumulating wealth relative to us. The source calls this accumulation by the rest of the world foreign saving.
Okay, so a current account deficit means positive foreign saving. Why is this foreign saving a negative source for our domestic corporate profits?
Because that net outflow of $30 represents money that left our domestic spending stream. It didn't circulate back to become revenue for U.S. businesses. As the source puts it, any net shift of wealth abroad leaves less new wealth in the economy available to be saved by business. It acts like another leak in the domestic revenue pipeline for businesses.
So running a trade deficit generally subtracts from the total pool of domestic profits.
That's what the flow analysis shows. Let's add this negative source to our equation. Profits, $60 plus net investment, $150. Personal saving, $60. Foreign saving, $30. This implies that when the U.S. runs a current account deficit, which means positive foreign saving, as it typically has for many years, international transactions tend to reduce aggregate U.S. corporate profits, all else being equal. If we ran a surplus, meaning negative foreign saving, that would actually add to domestic profits.
Wow, that really connects trade policy directly to the bottom line of domestic companies in aggregate. Okay, next big sector, step E, add the government sector. Taxes, government spending, deficits, surpluses, this has got to be important. Let's handle this in steps, maybe leave corporate profits tax aside for just a moment like the source does.
Good idea. Let's look at the flows between the government and households businesses first. Money flows to the government in various ways. Households pay personal income taxes, Social Security contributions, fees, $115 in the example. Businesses pay things like excise taxes, property taxes, separate from income tax, fees, $20.
How do these flows to government affect profits?
Money flowing from households to government is money they cannot then spend on business goods and services, so it diverts potential revenue away from businesses. Money flowing from businesses to government as nonprofit taxes are direct business expenses. Both reduce the profit potential.
Okay, now what about money flowing from the government?
The government also injects money into the economy. It pays wages to government employees, sends out Social Security checks, unemployment benefits, pays interest on government debt held by households, $150. It also makes direct purchases of goods and services from businesses and pays interest on debt held by businesses, $50.
How do these flows from government affect profits?
Payments to households provide them with income, some or most of which they will then spend, flowing back to businesses as revenue. Direct government purchases from businesses are immediate revenue for those businesses. Both of these flows boost business revenue.
So we have flows to government that reduce profits and flows from government that increase profits. It's the net effect that matters.
Exactly. What matters is the government's overall fiscal balance, excluding corporate profits tax for now. If the government takes more money out of the private sector, households and businesses, through taxes and fees than it injects back in through spending and transfers, it's running a surplus. That net withdrawal of funds from the economy acts like saving it diverts money away from the business revenue stream. So a government surplus, positive government saving, is a negative source of aggregate profits.
Okay, a surplus drains profits. What about a deficit, when the government spends more than it takes in?
If the government injects more money back into the economy through its spending and transfers than it takes out through these nonprofit taxes and fees, it's running a deficit. That net injection of funds adds to the overall flow of money circulating, which can then flow to businesses as revenue. Therefore, a government deficit, which is negative government saving, is a positive source of aggregate profits.
Wait a minute, let me process this. Are you saying a government budget deficit, something we constantly hear about as being problematic, a sign of fiscal irresponsibility, actually adds to the total pool of corporate profits? That seems completely upside down.
It feels incredibly counterintuitive, doesn't it? And look, there are absolutely valid and important long-term debates about government debt, sustainability, interest costs, and potential crowding out effects. This framework isn't dismissing those. But what the Kalicki-Levy flows method highlights is the immediate financial flow impact. When the government runs a deficit, mathematically its spending, which becomes income for households or revenue for businesses, is greater than the money it's taking out via these specific taxes and fees. That difference, the deficit amount, represents net injection of purchasing power into the economy, which directly boosts the potential revenue flowing to the aggregate business sector.
So the deficit itself represents money added to the economy that can become profit.
In this direct flow sense, yes. Let's use the example numbers. Government outlays are $150 to households, plus $50 to businesses, equals $200. Government revenues, excluding profits tax for now, are $150 from households, plus $20 from businesses, equals $135. The deficit is $200. $135 equals $65. This $65 deficit represents a net positive contribution to profits. Government saving would be revenue outlay, $235, $265, negative saving.
Okay, my mind is slightly blown again. Government deficits are a positive source for aggregate profits in this framework. Let's update the equation reflecting negative government saving. Profits, $125, plus net investment, $150, personal saving, $60, foreign saving, government saving, netted at $65. Subtracting a negative is the same as adding the deficit.
Precisely. We're nearly there. Just two more pieces to fit in to complete the picture. Corporate profits tax and dividends. Let's do step F. Add corporate profits tax. This is the income tax businesses pay to the government based on their earnings.
Okay, so surely this must be an expense that reduces profits. Businesses pay taxes out of their earnings.
Here's another crucial distinction the source makes. Corporate profits taxes are treated differently from other business expenses like wages or rent. Why? Because wages and rent are costs incurred in the process of trying to earn revenue and make a profit. Corporate profits tax, however, is calculated and paid after the profit has already been determined based on revenues and those operating expenses. It's considered a distribution of the profits already secured, not a cost of generating them.
Ah, so it's like slicing the pie after it's baked, rather than an ingredient cost while baking it.
That's a great way to think about it. The source says profits taxes flow directly from the net worth tank without passing through the profit meter, which measures profits before tax. In the flows model, all the other government revenues we discussed, personal taxes, excise taxes, either reduce the inflow to the business revenue pipe or increase the outflow from the expense pipe before profit is measured. The profits tax is taken out after the pre-tax profit number is established by those other flows.
So how does it show up in the final profit equation then? We want the equation for profits before tax.
Since the profits tax is a distribution of pre-tax profits, to calculate the pre-tax profit number itself, we need to add the amount of profits tax back. The other government flows determine profits before this tax is considered. The government saving term in the equation will now reflect total government revenue, including profits tax, which changes its value slightly. But the profits tax amount itself is added as a positive term to arrive at the pre-tax profit figure.
Right. The government saving number changes because its total revenue now includes profit taxes, but the tax itself gets added back to the profit sum we're calculating.
Exactly. The equation becomes profits, $125, less net investment, $150, personal saving, $60, foreign saving, $30, government saving, net of $5, plus profits taxes, $60. Notice the government saving number changed slightly in the example because its revenue side increased by the $60 profits tax.
Okay, got it. Last piece of the puzzle, step G. Add dividends. These are profits paid out by corporations to their shareholders.
Similar to corporate profits taxes, dividends are treated as shares of profits already obtained that are distributed to the firm's owners. They are not considered an expense incurred in the process of generating profit. In the flow model, they flow directly from the network tank to households or other shareholders like pension funds.
Okay, so money flows out of the business sector's net worth tank to shareholders. Wouldn't that make dividends a negative source for aggregate profits, like personal saving, money leaving the business sector?
This is perhaps the final and most counterintuitive piece of the flows method puzzle. Dividends are shown as a positive source of aggregate profits.
What? How can paying money out increase the profit number? That makes no sense.
Okay, stick with the flow logic.
Yeah.
When corporations pay dividends, say $40 in the example, to households, what can those households then do with that money?
They can spend it or save it.
Right. To the extent that they spend that dividend income on goods and services produced by the business sector, that spending flows back into the business sector's revenue pipe. So the $40 paid out can potentially return as $40 in revenue. And critically, this new revenue comes in without increasing expenses for the business sector as a whole in that period. The source notes that if we assume the overall personal saving rate doesn't change much just because of dividends, then most of the dividend payment tends to flow back as business revenue.
So, businesses make profit, they pay some out as dividends, the recipients spend those dividends, and that spending increases aggregate business profit again. It sounds like the business sector is paying itself, and that act of paying itself boosts its own collective profit.
It highlights the circular nature of income and spending in the economy. Money distributed by one part of the system can flow back as demand for another part. Adding this final positive source, Dividends, $40, gives us the complete identity derived from tracing the money flows. Profits, $165, plus net investment, $150, personal savings, $60, foreign saving, $30, government saving -$5, plus profits taxes, $60, plus dividend, $40.
Okay, let's stop and stare at that equation for a second. This is the complete picture, the result of following the money, and this is the famous Kalecki-Levy equation.
Yes, this full identity for the sources of aggregate profits is often called the Kalecki-Levy or Levy-Kalecki profit equation, named after the economists Michal Kalecki and Hyman Levy, who pioneered this type of analysis.
Let's state it one more time clearly. Profits equals plus net investment, personal saving, foreign saving, government saving, plus profits taxes plus dividends.
Or sometimes you see the saving terms grouped together. Profits plus net investment, total non-business saving plus dividends plus profits taxes, where total non-business saving is the sum of personal, foreign, and government saving.
And the key difference from the first method, the identity method, is that by tracing the flows, we've established the causality, right?
That's the argument. The flows method reveals how decisions made in different sectors translate into money movements that directly cause the aggregate profit level to change. Decisions by businesses to invest cause flows that increase profits. Decisions by households to save cause a diversion of funds that reduces profits. Government fiscal policy, deficit surpluses, causes net injections or withdrawals that impact profits. Trade flows cause shifts in revenue. Dividend payments, when spent, cause revenue to increase.
This leads to some really profound takeaways. The first one seems to be that aggregate corporate profits aren't just the result of millions of individual companies working hard and being efficient.
Right. While that's obviously important for individual company success, the total size of the profit pie available for everyone is fundamentally determined by these big macroeconomic financial flows, investment levels, and the spending versus saving decisions happening outside the business sector in households, the government, and the rest of the world.
And the second big takeaway seems to revolve around that strange aphorism you mentioned. Capitalists earn what they spend. How does this framework explain that?
It captures a core idea here. While an individual business owner can't just spend wildly and guarantee themselves a profit, the collective spending of the entire business sector, primarily through investment, buying capital goods from other businesses, plus the spending that comes back from distributions like dividends, plus the spending injected by government deficits, generates the aggregate income, revenue minus nonprofit expenses, that ultimately constitutes the total profit pool for the business sector as a whole. Their collective actions, combined with the actions of other sectors, determine their collective income.
It's a very different way of looking at where profits come from than just focusing on individual company performance. Let's see how this plays out in the real world. The research provides some evidence, right? Especially looking at the impact of government deficits.
Yes, the KRL equation suggests a very direct link. Government deficits, negative government saving, should be a positive source of profits. The source material states that deficits directly inject money into the economy, which boosts overall demand for goods and services, leading to a subsequent boost in corporate earnings.
Can we see this historically?
The source points to a couple of powerful recent examples. First, consider the aftermath of the 2008 global financial crisis. What happened to business investment then?
It plunged, right. Businesses got scared, stopped spending.
Exactly. Private investment fell sharply. Based on the KRL equation, that drop in investment should have crushed corporate profits. But what else was happening simultaneously?
Huge government response. Bailouts, stimulus spending, massive deficits.
Precisely. The source notes that aggressive government deficit spending dramatically increased during this period. And according to this framework, that deficit spending acted as a direct positive source for profits, counteracting the negative impact of falling private investment. In fact, the source says this deficit spending directly contributed to a rapid recovery and new highs in corporate profits in the years that followed, even while private business investment was still relatively weak.
So the government deficit effectively filled the hole left by collapsing private investment, propping up aggregate profits.
That's the interpretation based on the KL flows. And we saw an even starker, maybe faster example during the COVID-19 pandemic.
Right. Lockdowns, huge parts of the economy shut down. Business investment must have tanked again.
It did, very sharply initially, but what was the government response?
Unprecedented levels of spending, stimulus checks directly to people, enhanced unemployment benefits, loans, and grants to businesses. The deficits were astronomical.
And the source highlights this unprecedented scale of government deficit spending. What happened to corporate profits, according to the KL logic? That massive deficit, negative government saving, should have provided a huge boost.
It did it.
Remarkably, yes. The research states that this deficit spending rapidly propelled corporate profits to an all-time high by Q4 2020, just a few quarters after the pandemic hit, even while the real economy was still significantly disrupted. That money injected, especially the transfers to households, fueled consumer spending, which flowed straight back to businesses as revenue, driving profits up despite the chaos.
That's incredible. Deficits acting as a powerful counterforce during crises.
It really demonstrates the potential role of government deficits as a countercyclical force, as the source called it. It can support aggregate profits, especially during economic downturns, precisely when private sector components like investment might be failing. It directly offsets those declines. The source even makes the provocative point that historically, periods of high government debt haven't always coincided with weak corporate earnings. Sometimes the opposite is true, challenging the simple narrative that government debt is purely a drag. It can have this direct positive impact on corporate balance sheets by stimulating demand.
Now, the research includes an important caveat here, right, about the quality of those profits.
Yes, absolutely. While deficits can clearly boost the level of profits, there's a valid concern raised about the quality or the long-term sustainability of profits that are primarily driven by government borrowing rather than by organic productive investment. Businesses investing in new technologies, becoming more efficient, creating genuinely new value. If high profit levels rely mostly on temporary government stimulus, it might mask underlying weaknesses or economic mediocrity.
So profits driven by investment might be seen as healthier or more sustainable in the long run.
That's the argument. It raises questions about whether an economy generating profits, mainly through deficits, is truly building productive capacity for the future.
Let's look at another driver, household savings. The equation showed personal saving as a negative source.
Right. Rising household saving rates are seen as a direct drag on aggregate profits in this framework because it represents income that is not spent back into the business sector as revenue.
Did we see the opposite of this recently, too?
Yes. Think about what happened after the initial phases of the pandemic. Many households had accumulated extra savings, partly from stimulus payments, partly because they couldn't spend on things like travel or restaurants during lockdowns.
So-called excess savings.
Exactly. And when the economy reopened more fully, what did people do?
They went on a post-pandemic shopping spree, as the news called it. Huge surge in consumer spending.
Right. And the source notes that this release of pent-up demand and accumulated savings, quote, directly translated to increased corporate profitability. More household spending meant more money flowing into the business revenue pipe, boosting the aggregate profit pool.
It also works the other way, though, if things get tough economically.
Yes, the source points out that factors like high inflation eating away at purchasing power or rising interest rates making borrowing more expensive can increase the impulse for households to save more or borrow and spend less. This can create a negative feedback loop in an economic downturn. Lower consumption hits business revenues. Businesses might respond by cutting back on hiring or investment, which further dampens economic growth and could increase households' perceived need to save.
This framework really hammers home how interconnected everything is. Corporate profits aren't determined in isolation. They are deeply intertwined with the financial positions and spending and saving behaviors of other economic sectors. If households save more, or the government saves more, runs a surplus, or foreigners save more relative to us, we run a trade deficit, any net saving by a non-business sector directly reduces the aggregate profit available to the business sector.
And that brings us to the foreign trade balance again. Foreign savings, which is essentially the flip side of our current account deficit or trade deficit, directly subtracts from domestic corporate profits.
Because it's money flowing out.
Yes, it represents domestic spending by households or businesses
Yeah.
that gets diverted to pay for imports or make other payments abroad instead of flowing back as revenue to domestic producers.
Is there historical evidence for this drag?
The source points to the period after 2000, when the U.S. saw a significant increase in its current account deficit, meaning foreign saving increased substantially, especially relative to countries like China. This large and growing trade deficit acted as a persistent drag on domestic corporate profits during those years, according to the KL framework's logic.
So, putting all this evidence together, it seems these macro flows, investment, government deficits, household saving, trade balances really do drive the aggregate profit number in predictable ways, even if those ways are sometimes counterintuitive.
That's the core argument based on the KL analysis. It forces us to think about the sources of profit. And this raises that critical question about sustainability again. Are today's profits high because businesses are investing heavily in productive capacity, the investment term, or are they being propped up by, say, large and potentially unsustainable government deficits, or a temporary dip in household saving? If stock market valuations are based on assuming current high profit margins will last forever, but those margins actually depend on temporary or unsustainable factors, that poses a critical risk for investors and a challenge for policymakers. The source, the quality of aggregate profits, really matters for assessing economic health and future stability.
Okay, so the Kalecki-Levy equation provides a powerful accounting framework for understanding the sources of the total profit pool based on these macroeconomic flows. But it doesn't necessarily tell the whole story about why profit exists in the first place or how individual companies actually manage to compete, innovate, and earn their specific share of that pool, does it?
No, exactly. The source is clear that the KL equation is fundamentally an accounting identity. It tells us where the money-defining profit comes from in terms of these aggregate financial flows. But it doesn't on its own explain the deeper why. Why do firms invest in the first place? How do they achieve the revenues that contribute to the flows? What are the underlying economic or social reasons that allow for profit generation?
So we need other economic theories to get a fuller picture.
Precisely. The source emphasizes that various schools of economic thought offer complementary perspectives on how and why profits emerge, how they're distributed, and what they represent. Looking at these different theories gives us a richer, more nuanced understanding than any single theory can offer on its own. They add layers to the KL identity.
Let's touch on some of the main ones mentioned. First up, neoclassical theory. This is probably the one most people encounter in introductory economics, right?
Very likely, yes. The core idea in neoclassical theory is that profit is essentially a reward. It's a reward for using capital and other resources efficiently, for taking on the necessary risks involved in production, and for successfully creating value that consumers are willing to pay for in competitive markets.
How does it work in this view?
Firms are seen as trying to maximize their profits by finding the optimal combination of inputs, labor, capital, materials, entrepreneurship to produce goods or services at the lowest possible cost. The potential for profit arises from the interplay of supply and demand, consumer preferences, utility, and the firm's own cost structure. If you can efficiently produce something people value, market forces allow you to earn a profit, which signals that you're allocating resources well. The focus is really on market efficiency and optimal resource allocation.
But the source we looked at also brings up some criticisms or limitations of this view.
It does. Critics argue that the standard neoclassical model sometimes overlooks important real-world factors, things like the unequal distribution of resources and power to begin with, the potential for powerful actors to shape markets to their advantage rather than just responding efficiently, or the possibility that the relentless pursuit of profit maximization might lead to negative consequences like increased inequality, exploitation of labor, or environmental damage. It also often relies on simplifying assumptions like perfectly rational actors, perfect information, and smoothly self-regulating markets that may not always hold true.
Okay, so neoclassical sees profit as a reward for efficiency in competitive markets. What about Marxian theory? A very different perspective.
Radically different, yes. In Marxian theory, profit is understood fundamentally as surplus value that is extracted from labor.
Surplus value, what does that mean?
The core idea is that workers, through their labor, create more economic value during their working day than the value they receive back in the form of wages. Capitalists, who own the means of production, factories, machines, purchase the workers' labor power, their capacity to work for a certain period at its market value, the wage needed to sustain the worker. However, during the time they work, the capitalist compels the worker to produce goods whose value is greater than the wage paid. That difference, the value created by the worker beyond their own cost, is the surplus value, which, when the goods are sold, is realized by the capitalist as profit.
So the profit isn't seen as a reward for the capitalist's efficiency, but as value generated by the worker that isn't returned to them.
That's the essence of it. Marx discussed different ways to increase this surplus value. Absolute surplus value comes from extending the working day without increasing wages. Relative surplus value comes from increasing worker productivity through technology or better organization, so they produce more value in the same amount of time, effectively cheapening the value of their own labor power relative to what they produce. If a worker gets paid $10 an hour, but produces goods that embody $40 worth of value in that hour, the Marxian view sees that difference as stemming from the exploitation of labor. This theory obviously focuses heavily on income distribution, power dynamics between capital and labor, and offers a fundamental critique of the capitalist system itself.
Very different lens. Now, Schumpeterian theory. This one focuses on innovation.
Yes, Joseph Schumpeter offered a dynamic view where profit is seen as a temporary reward for successful innovation and entrepreneurship. He coined the famous term creative destruction.
Creative destruction, the idea that new innovations destroy old industries and ways of doing things.
Exactly. Schumpeter argued that the key driver of economic progress and profit isn't just managing existing resources efficiently, but introducing fundamental changes. Entrepreneurs disrupt the status quo by bringing novel products or services to market, developing new production processes, finding new ways to organize businesses, or opening up entirely new markets.
And how does that generate profit?
This successful innovation gives the entrepreneur a temporary edge, almost like a mini monopoly, before competitors can catch up. This temporary market power allows them to charge prices well above their costs and earn supernormal profits for a period. Think about the first company to introduce a truly revolutionary product.
Like the first smartphones, maybe. Or the companies pioneering online retail.
Perfect examples. They disrupted existing industries and reaped huge profits initially. But, Schumpeter stressed, these profits are usually temporary. Eventually, other firms imitate the innovation or even leapfrog it with something better. Creative destruction continues. Competition heats up again, and those supernormal profits get competed away. So in this view, profit is the lure that encourages entrepreneurs to take risks and innovate, driving economic dynamism, but it's inherently transient.
Okay, profit as a reward for innovation. What about institutional economics? This sounds like it brings in the rules of the game.
It does. Institutional economics emphasizes that economic activity, including profit generation, doesn't happen in a vacuum. It's shaped by the prevailing institutions, the formal rules like laws and regulations, the informal rules like social norms and conventions, market structures, and underlying power dynamics.
How do institutions affect profit?
They influence everything from how resources are allocated to how corporations are governed to the intensity of competition. A key concept highlighted in this source from this perspective is rent-seeking.
Rent-seeking. Is that about landlords?
No, it's a different use of the word rent. In economics, rent-seeking refers to attempts by individuals or firms to increase their own wealth or profits, not by creating new value or being more productive, but by manipulating the social or political environment to their advantage.
Like lobbying the government for special favors.
Exactly. Lobbying for subsidies, tax breaks that only benefit your industry, regulations that create barriers for potential competitors, or securing exclusive licenses. It's about capturing existing wealth or diverting income streams to yourself without contributing to overall economic output. Institutional economists view rent-seeking as often leading to resource misallocation, stifle competition, reduced efficiency, and ultimately lower overall economic welfare. It's seen as a flaw in the design or implementation of economic and political institutions that allows profit to be gained through power plays rather than production. This perspective focuses heavily on the regulatory environment and how power imbalances shape economic outcomes.
So profit might come from genuine production, or it might come from manipulating the system. That's a critical distinction. Lastly, the source mentions risk uncertainty theory associated with Frank Knight.
Right. Frank Knight made a really important distinction between risk and uncertainty. He argued that profit is specifically the compensation entrepreneurs receive for bearing true uncertainty.
What's the difference between risk and uncertainty in his view?
Calculable risk refers to situations where the possible outcomes are known, and the probability of each outcome can be reasonably estimated, perhaps based on past data. Think about insurance companies calculating the risk of car accidents based on statistics. You can measure it, manage it, even insure against it. The costs associated with calculable risk can be treated like any other business cost.
But uncertainty.
True uncertainty, in Knight's view, refers to situations where the potential outcomes, or their probabilities, are fundamentally unknowable. You can't calculate the odds because it's genuinely novel or unpredictable. Think about the market reception for a radically new invention, something that has never existed before, or the economic impact of a sudden, unforeseen geopolitical event. Entrepreneurs who commit resources in the face of this uninsurable, unknowable future and happen to be successful earn profits as a reward for navigating that true uncertainty.
So profit isn't just for taking risks you can calculate, but for stepping into the unknown.
That's the core idea. It links to the concept of a risk premium in finance, too. Investors often demand a higher potential return for investing in something whose future is highly uncertain, rather than just statistically risky. This theory focuses on the unique role of the entrepreneur in making judgments and commitments under conditions where rational calculation alone isn't possible.
Okay, that's quite a range of explanations for profit. Efficiency reward, surplus labor value, innovation reward, outcome of institutional power, reward for bearing uncertainty. How do these theories fit together with the Kalecki-Levy equation we spent so much time on?
They are complementary lenses. The Cahill equation gives us the macroeconomic accounting identity. It describes the sources of the aggregate profit pool in terms of financial flows, investment, saving, deficits, etc. These various economic theories try to explain the mechanisms and rationales behind those flows and the distribution of profits.
So KL tells us what adds up to total profit, and the theories tell us why those things happen or how individual firms capture a slice.
Exactly. For example, Schumpeterian innovation, developing new products, processes, is often what drives the business decisions that lead to the net investment term appearing in the KL equation. Institutional factors, like the degree of market power or successful rent-seeking, can influence how large a share of the total KL profit pool a particular firm or industry can command. Marxian theory focuses on how the initial value is generated that allows for profit within the production process before it even enters the KL flows. Neoclassical theory explains the pressures for efficiency that firms face in trying to generate revenue that contributes to the flows. Knight's uncertainty helps explain the motivation for undertaking the kind of novel investments that show up in KL. They address different facets of the profit phenomenon.
And understanding these different theories is important because they imply different things about policy, right?
Absolutely. If you believe profits mainly come from neoclassical efficiency, you'd likely advocate for free markets and minimal intervention. If you emphasize Schumpeterian innovation, you'd want policies that support R&D and entrepreneurship. A Marxian perspective might suggest fundamental changes to ownership and control. An institutionalist focus would lead to calls for strong regulation, antitrust enforcement, and campaign finance reform to curb rent-seeking and undue influence. And the KL framework itself highlights the direct impact of fiscal policy, deficit surpluses, on profits. It really shows the political economy of profit. Different views on where profit comes from lead to very different ideas about which profits are beneficial, which are detrimental, and what government should do about it.
Okay, so we have the macro picture from KL setting the size of the total profit pie, and we have theories explaining why profit exists and how it might be generated. But within that environment, day to day, why does one specific company, say, in the same industry, make huge profits while its competitor struggles or even fails? That comes down to microeconomic factors, right?
Precisely. The KL equation determines the level of the macro tide, as you put it earlier.
Yeah.
Macroeconomic factors determine how well each individual microboat navigates that tide and how much of the available profit pool it manages to capture. Why is Starbucks often more profitable than a local coffee shop, even when the overall economy, the tide, is the same for both?
The source material breaks this down into factors that are mostly internal to the company, things they can control, and factors that are external, largely outside their direct control.
Let's start with the internal factors. A huge one is operational efficiency. How good is the company at converting inputs like coffee beans, labor, electricity into outputs like a cup of coffee sold, effectively and with minimal waste? This covers everything from supply chain management to store layout to how productive the employees are. Good management is key here.
Related to that is cost management. Meticulously tracking and controlling all the costs, materials, labor, rent, marketing, without hurting the quality of the product or the ability to operate. If you can produce the same quality coffee, but at a lower cost than your competitor, you have a significant advantage.
Pricing strategy is another internal lever. How do you set your prices? Are you aiming for volume with low prices, like maybe a Dunkin', or higher prices based on perceived quality or experience, like a specialty cafe? Are you using dynamic pricing? Finding the right balance between being competitive and ensuring you cover costs and make a healthy margin is crucial.
The company's product mix also matters. Are they highly focused on just one thing, or do they offer a diversified range of products? Diversification can spread risk, but it can also spread resources too thin. Making strategic choices here is important.
And critically, talent management. Attracting, training, motivating, and retaining skilled employees. A company's workforce, its human capital, is a massive asset. Investing in employees can boost productivity, foster innovation, and improve customer service, all of which contribute to profitability.
So those are things a company can largely influence itself.
What about the external factors, the ones they mostly have to react to?
The big one is overall market conditions. What's the general state of the economy? Is there strong consumer demand, or are people tightening their belts? Is the economy in a boom or a recession? A recession hurts demand across most industries, making it harder for almost everyone to be profitable.
The competitive landscape is obviously huge too. How many direct competitors do you have? Are they large or small? Are they competing aggressively on price? Intense competition tends to put downward pressure on prices and profit margins for everyone in the industry. Companies constantly need to find and defend their competitive advantage. What makes them stand out? Is it lower cost, better quality, unique features, superior service, faster delivery? Technological advancements are another major external force. New technology can be an opportunity. It might allow a company to lower its costs, improve its products, or reach customers in new ways. But it can also be a threat. If a company fails to adapt to technological changes that its competitors adopt, its products or processes can become obsolete, leading to declining market share and profits. Think about how digital photography disrupted Kodak, or how streaming is disrupting traditional media. AI and automation are huge technological shifts happening right now.
The regulatory environment is external too. Government policies on things like minimum wage, environmental protection, workplace safety, international trade rules, and, of course, taxes, all of these can significantly impact a company's cost structure, its ability to operate in certain markets, and its overall profitability. Companies have to navigate and comply with these rules.
And for businesses involved in international trade or finance, currency fluctuations can be a major factor. Changes in exchange rates can affect the cost of imported materials or components, and they can make a company's exports cheaper or more expensive for foreign buyers, impacting international competitiveness and profits earned abroad.
So it's this constant dance between the big macro forces setting the overall profit environment, the KL factors, and these micro factors determining how well an individual company performs within that environment.
Exactly. And the source emphasizes that in today's fast-changing world, just being statically efficient isn't enough for sustained profitability. What's needed is a continuous capacity for innovation and adaptation. Companies need to be agile, constantly scanning the horizon, adjusting their strategies, investing in R&D. Profit generation isn't a one-time calculation. It's a continuous process of dynamic adjustment and strategic foresight. The firms that can adapt and innovate are generally better positioned to capture a larger share of the available profit pool over the long haul.
Okay, so companies generate profit through this mix of macro conditions and micro execution. Once they have earned a profit, how is it actually measured for different purposes? And what do they typically do with that money?
Let's tackle measurement first. The most common measure, the one you usually see on financial statements reported to the public and used for calculating taxes, is accounting profit.
And that's just.
Simply, the total revenue a company brings in minus its explicit costs. Explicit costs are all those direct out-of-pocket expenses you can easily track. Wages and salaries paid, rent for buildings, cost of raw materials, utility bills, marketing expenses, interest paid on debt. It's a tangible, traceable number. Think of it as the bottom line based on the clear money flows recorded in the books. It gives you a snapshot based on standard accounting rules.
Okay, accounting profit equals revenue explicit costs. But the source mentions another type, economic profit. How is that different?
Economic profit takes a broader, maybe deeper view. It's calculated as revenue minus explicit costs minus implicit costs.
Implicit costs, what are those?
Implicit costs represent the opportunity costs of the resources used by the business. Opportunity cost is the value of the next best alternative that was given up by choosing to use a resource in a particular way. These costs aren't usually recorded in the accounting books because no money actually changes hands for them.
Can you give an example?
Sure. Let's say you run a small business out of a building that you personally own outright. Your accounting profit calculation wouldn't include any costs for rent because you don't actually pay rent to anyone. But there's an implicit cost. The rent you could have earned if you had leased that building out to another business instead of using it yourself. That foregone rental income is an opportunity cost, an implicit cost of using the building for your own business.
Okay, or like the salary the business owner could be earning if they worked a regular job elsewhere instead of running their own company.
Exactly. That foregone salary is another common implicit cost. Economic profit tries to capture whether the business is generating true value above and beyond what could have been achieved by deploying those resources, the owner's time, the capital invested, the building, in their next best alternative use.
Why is this distinction important?
Because a company can actually have a positive accounting profit, but a negative economic profit. It might be making money according to the books, but it might not be generating enough return to cover the opportunity costs. It might actually be destroying value compared to what those resources could have earned elsewhere. Economic profit gives a truer picture of whether the business is adding real economic value and helps in making strategic decisions about whether to continue, expand, or perhaps redeploy those resources. It accounts for that hidden cost of opportunity.
Okay, so accounting profit is for reporting. Economic profit is for deeper strategic understanding. Now, once a profit, let's assume accounting profit for simplicity now, is earned, what happens to it? How is it distributed or used?
The company has several options. One major use is paying dividends. This is when the corporation distributes a portion of its profits directly to its shareholders, the owners of the company. This can be paid in cash or sometimes as additional shares of stock.
That's a way to reward the investors for putting their capital at risk.
Exactly. It provides a return to shareholders and acts as an incentive for investment. Of course, paying dividends reduces the amount of cash the company holds and lowers its retained earnings. And remember, in the KL framework, dividends paid out when spent by recipients actually loop back as a positive source contributing to aggregate profit generation.
Right, that counterintuitive loop. What's another major use of profits?
Retained earnings. This is the portion of the profit that the company keeps after paying out any dividends. It's the cumulative profit that hasn't been distributed to owners. Retained earnings are a crucial source of internal financing for the business.
So they use retained earnings to reinvest back into the company.
Yes, it's used to fund things like research and development,
Right.
R&D, for new products, expanding operations, building new facilities, buying more advanced equipment, which is capital expenditure or investment, or paying down existing debt. As Mikhail Kalecki himself noted, profits earned provide the internal financial resources that enable businesses to undertake future investment. This links directly back to the investment term in the KL equation.
So profits can fund the investment that generates future profits, a feedback loop.
Potentially, yes. Some profits also go towards executive compensation, the salaries, bonuses, and stock options paid to the company's top managers. While technically an operating expense, very high levels of executive pay relative to performance are sometimes debated as being closer to a distribution of profits than purely a cost of management, especially concepts like disguised dividends.
And what about stock buybacks? We hear a lot about those.
Stock buybacks or share repurchases are when a company uses its cash, often derived from profits, to buy back its own shares from the open market. This reduces the number of shares outstanding, which tends to boost the earnings per share and the stock price, returning value to the remaining shareholders. In the KL framework, stock buybacks are often treated similarly to dividends as a distribution of profits back to the owners of capital.
So companies face a strategic choice. How much profit should we distribute to shareholders now, via dividends or buybacks, versus how much should we retain and reinvest in the business for future growth?
Exactly. It's a fundamental strategic decision with significant long-term implications for the company's growth trajectory, financial health, and ultimately its market value. And this decision also has macroeconomic implications, influencing the aggregate levels of investment, funded by retained earnings, and potentially consumption, funded by distributed profits, described in the KL equation. There's often a tension between maximizing short-term returns to shareholders and investing for long-term sustainable growth.
Finally, let's bring taxation back into the picture more fully. We touched on corporate profits tax when building the KL equation, but how does taxation impact profits more broadly?
Well, the most direct effect is straightforward. Corporate income taxes reduce the company's net profit, the profit available after taxes for reinvestment or distribution. The government takes a slice of the pre-tax profit.
But the source suggests there are more complex indirect effects too, especially relating back to the KL equation.
Yes, taxes in general tend to create disincentives for the activity being taxed. So, a corporate income tax could potentially act as a disincentive for businesses to undertake investment, which we saw as a key positive source of profits in the KL equation. If the potential after-tax return on investment is lower, companies might invest less.
Could taxes also affect the foreign saving term?
They could. For multinational corporations, differences in tax rates between countries can create strong incentives to shift where they report their profits, using legal accounting maneuvers, or even where they physically locate their operations or hold their earnings. If higher domestic taxes encourage companies to keep earnings overseas or invest abroad instead of domestically, that could potentially increase the net outflow of funds, contributing to foreign saving, a negative source in KL, from the U.S. perspective. It creates these quite complex feedback loops within the economic system.
This leads right into the ongoing debate about what the corporate tax rate should be. The source outlines some of the arguments typically made on both sides. What are the arguments usually given for raising the corporate tax rate?
The proponents often argue it promotes fair taxation, ensuring large, profitable corporations contribute adequately to public finances, perhaps closing loopholes that allow some to pay very little.
Hmm.
Some argue it can specifically target excess profits that might arise from market power or rent seeking, linking back to institutional economics, potentially curbing those practices. Raising taxes on foreign earnings, like the GILTI provisions in the U.S., could reduce the incentive for companies to shift profits or operations abroad, encouraging more domestic investment instead. And of course, higher corporate tax revenue can be used to fund public services, infrastructure, or reduce deficits, potentially shifting the tax burden away from individuals or smaller businesses.
And what are the counter-arguments, the points made against raising the corporate tax rate?
Opponents frequently argue that the burden of the corporate tax doesn't actually fall on the corporation itself, but gets passed on either to consumers in the form of higher prices, or to workers through lower wages or fewer jobs, or to shareholders via lower returns. They argue it can reduce households' purchasing power and business income. A major concern is competitiveness. If one country raises its corporate tax rate significantly higher than others, it could incentivize companies to relocate their headquarters, operations, or at least their reported earnings, leading to a loss of domestic investment and jobs. The broader argument is that higher corporate taxes burden investment, reduce aggregate output, decrease after-tax incomes across the board, and that these negative effects compound over time, ultimately weakening the economy.
This sounds like the debate behind things like the push for a global minimum corporate tax.
Exactly.
Yeah.
Efforts by groups like the G7 in over 130 countries to establish a global minimum tax rate, around 15%, are aimed precisely at limiting this race to the bottom, where countries compete by offering ever lower tax rates to attract multinational business, which erodes the tax base everywhere. The goal is to reduce the incentives for profit shifting. However, actually implementing and enforcing such a global agreement faces significant practical and political challenges.
And the source makes the point that this isn't just about economics, right? It's deeply political.
Absolutely. Debates about corporate taxation are rarely just about finding the economically optimal rate. They are deeply intertwined with political ideologies and differing views on fairness, income distribution, and the fundamental role and responsibilities of corporations within society. Public opinion often shows support for taxing big corporations more heavily, reflecting a normative dimension, a sense of what should be fair. Arguments about taxing excess profits also tap into this, often implicitly linking those profits to market power or perceived unfair advantages, rather than just earned rewards for efficiency or innovation.
Okay, we have covered a huge amount of ground here, diving deep into the surprisingly complex question of where corporate profits really come from. Let's try to synthesize and summarize the key takeaways.
It's definitely not a single, simple answer, is it? We've seen it's this intricate dance between different levels and forces. Fundamentally, at the aggregate level, the total pool of profits seems to be shaped by those macroeconomic financial flows described by the Kalecki-Levy identity.
Right. Aggregate net investment by businesses adds to the pool. Government deficits, negative saving, add to the pool. Spending, fueled by dividend distributions, adds back to the pool.
While on the other side, personal saving by households drains from the pool.
And
Foreign saving, representing our current account or trade deficit, also drains from the pool available for domestic businesses. And the causality revealed by the flows method is often counterintuitive. Spending and investment by certain sectors generate the aggregate profit.
But the KL identity isn't the whole story. We also looked at those complementary economic theories.
Yes, they offer important insights into why profits might exist in the first place, and how they are captured at a more micro or fundamental level. Explanations range from profit being a reward for efficiency, neoclassical, or innovation, Schumpeterian, to being surplus value extracted from labor, Marxian, or gain through market power and institutional advantages, institutional, or as compensation for navigating true uncertainty, Knight. These provide different lenses on the nature of profit itself.
And then, drilling down to the individual firm level, we saw that microeconomic factors are crucial.
Absolutely. Operational efficiency, cost control, pricing strategy, innovation, talent management. These internal factors, combined with how well a company adapts to external conditions like competition and technological change, determine its ability to actually capture a slice of that aggregate profit pool defined by the macro KL factors. It requires continuous adaptation and strategic foresight.
And finally, taxation plays a dual role, directly reducing net profits, but also creating complex indirect effects on investment, location decisions, and potentially other terms in the KL equation itself.
So what does all this mean for you listening to this? How can you use this understanding?
Well, first, it gives you a much more powerful lens for understanding economic news and debates. When you hear reports about government spending plans, changes in the trade deficit, or shifts in household saving rates, you now have a framework to see how these might directly impact the total volume of profit available to all businesses. And that, in turn, influences business decisions about investment and jobs, affecting the overall economic cycle. It connects the dots between seemingly abstract macro numbers and the real economy.
If you're interested in investing, this perspective encourages you to look beyond just a single company's impressive earnings report. You should also consider the macro context driving aggregate profits. Is the overall profit pool high because of strong, sustainable business investment across the economy? Or is it perhaps being temporarily boosted by large government deficits or unusually low household saving? Understanding the source or the quality of aggregate profits can be key to assessing the sustainability of individual company performance and identifying potential risks if profits are relying on unstable foundations.
And just as a citizen thinking about policy issues,
This deep dive shows that debates around things like government debt, corporate taxes, or trade policy aren't just technical arguments about numbers. They involve fundamental questions about how wealth is created and distributed in our society. What is the proper role of government? What responsibilities do corporations have? The different economic theories we discuss show there isn't one single universally agreed upon answer to what profit is or what kind of profit generation is most beneficial. Understanding these different perspectives helps you engage more deeply with these important public debates.
we've definitely explored some surprising, even jarring ideas today. The notion that individual saving, while prudent for a household, can collectively act as a drag on total business profits.
Or the idea that government deficits, often portrayed solely in a negative light, can be a direct source fueling corporate earnings, especially during downturns.
It really challenges some deeply ingrained assumptions.
So here's a final thought to leave you with, building on everything we've discussed. In an economy where the total pool of profits seems to depend so heavily on the spending and saving decisions of other sectors, where household thrift can reduce profits and government deficits can boost them, what does this interconnectedness imply about the inherent stability or perhaps instability of our current economic system? If profits become increasingly reliant on, say, continuous government deficits rather than private investment, what does that mean for the future nature of wealth creation and economic growth itself?
That's a lot to chew on. It certainly emphasizes that understanding where profits truly come from is a crucial piece of understanding the complex financial world that shapes all of our lives.